Hey there, and welcome. Have you ever glanced at your payslip and had that little voice in your head ask, Am I paying too much tax? If so, you're in exactly the right place. We're about to pull back the curtain on the UK's tax system for the 2025/26 year.
So let me just ask you that question straight up. Are you overpaying your tax? It's a really simple question, but the answer could literally be costing you hundreds, maybe even thousands of pounds every single year.
Okay, let's put a number on it. £700. On average, that's how much millions of people in the UK overpay in tax each year. And we're not talking about some super complex, sneaky schemes here. We're talking about simple stuff. Errors, the wrong tax code, or just missing out on allowances you're entitled to.
Now, trying to navigate all of this on your own can feel, well, pretty overwhelming, right? But you don't have to. This whole discussion has been put together by the experts over at Pro Tax Accountant. They live and breathe this stuff, and they've designed this guide to help you get a real grip on your money. All right, let's get into it. We're going to start by building a really solid foundation, the absolute essentials of UK income tax. Understanding this first part is absolutely crucial for everything else we're going to talk about. Right, here they are, the numbers that really matter for most of us in England, Wales, and Northern Ireland. So the first chunk of your earnings, up to £12,570, is your personal allowance. That's yours to keep, completely tax-free. After that, you'll pay 20%, then 40%, and for the highest earners, 45%. But here's the kicker. These thresholds are frozen, and are staying frozen until 2028. And that freeze is what leads to this thing called fiscal drag. Honestly, it's basically a stealth tax. Think about it. Your wages might go up a bit to cover the rising cost of living, but because the tax bands aren't moving, more and more of your money gets dragged into a higher tax bracket. So, you might not feel any richer, but you end up paying a higher rate of tax. Sneaky, right? So, how does this actually work in the real world? Let's take an example. This is Tom. He's a teacher and he earns £38,500 a year. So, first step, we take away his tax-free personal allowance. That leaves him with £25,930 of taxable income. Now, because all of that falls into the basic rate band, we just calculate 20% of it, which works out to £5,186 in tax. Seems simple enough, but it only works if your tax code is right in the first place. And that brings us to our next critical point, your tax code. It might look like just a random jumble of letters and numbers on your payslip, but getting it wrong can be so costly. Let's take a look at how to crack it. Now get this, 1 in every 8 tax codes is wrong. Just think about that for a second. That's a massive number of people potentially paying the wrong amount of tax. For most people with one job, the code should be 1257L. The good news, you can check yours really easily. Just log into your personal tax account on the gov.uk website. It'll take you 2 minutes, and it could literally save you hundreds of pounds. Okay, so we've covered the basics of income tax. Let's switch gears and talk about dividends. Now, this next bit is absolutely essential if you're a business owner, a director of a limited company, or an investor, because this is where some really smart planning can make a huge difference to what you actually take home. So first things first. Everyone gets a £500 tax-free dividend allowance. That means your first £500 of dividends is tax-free. After that, the rate you pay depends on which income tax band you're in. And you'll notice these rates are lower than income tax, which is great. But, and this is a big but, this tax is applied on top of all your other income. This is the bit that catches people out. Your salary can easily push your dividends into a higher tax bracket, so you really have to look at the whole picture. And that leads us perfectly into what is probably the most valuable part of this whole discussion for any business owner. How should you actually take money out of your company? Salary or dividends? Getting this right can save you an absolute fortune. And stay with me, because this next slide shows you exactly how. Just look at this. It's so powerful when you see it side by side. Meet Priya, a consultant earning just over £52,000. If she takes it all as salary, she's hit with both income tax and national insurance. The tax man takes over £11,000. But look at the smart way. A small salary of £12,570 and the rest in dividends. Her total tax bill plummets to just over £4,000. That's a saving with more than £7,000 in 1 year. That is the power of smart income structuring. So you're probably asking, what's the magic number for that salary? Well, here's a fantastic pro tip directly from the team at Pro Tax Accountant. The sweet spot is often £12,570. Why? Because it's just high enough to count as a qualifying year for your state pension, but it's low enough that you don't pay any income tax on it. Or, if you wanted, you could take just £9,100 and avoid paying any national insurance at all. It all comes down to your personal situation. Okay, knowing the rules is one thing, but knowing the traps to avoid is a whole other ballgame. Let's quickly run through some of the most common pitfalls, because this is where so many people get tripped up. You definitely don't want to get caught out.
Let's do a quick fire round. First, the child benefit charge. If you or your partner earn over £60,000, you have to start paying back that child benefit. Next, for our viewers in Scotland, your tax bands are different and a bit narrower, which means you can hit those higher tax rates sooner. Third, a huge mistake for business owners, taking only dividends. It might seem smart, but you'll miss out on qualifying years for your state pension. And finally, emergency tax codes. If you see one on your payslip, sort it out fast, because you are almost certainly overpaying tax. And a really important note for all you contractors out there, you have to know about the IR35 rules. If your contract means you're considered inside IR35, HMRC basically treats you like an employee for tax purposes. If that's the case, taking dividends is not tax efficient at all, and your income needs to go through PAYE as a normal salary. This is a super complex area, so getting it right is vital.
Phew, okay. We have covered a huge amount of ground. So let's bring it all together and boil it down into a simple financial health check. The key things you should take away and act on, maybe even today. Here is your action plan. First, log into your HMRC account and check that tax code. Second, make a plan to actually use that $500 dividend allowance. Third, if you run a business, sit down and do the math on your perfect salary versus dividend mix. And finally, keep those traps we talked about in mind and never ever assume the numbers are right. Always check them. And that really brings us to the final point. I get it. Tax can feel like a minefield. The rules are complicated and they seem to change all the time. But while being informed is your best defense, you absolutely do not have to figure all this out by yourself. If you want personalized advice that's tailored to your exact situation, whether that's structuring your income as a director, making sense of IR35, or just wanting peace of mind that you're not overpaying, you should get in touch with the experts who put this all together. You can reach Pro Tax Accountant on WhatsApp or by phone at 07985 689912, or just drop them an email at info@protaxaccountant.co.uk. And just before we finish up, a really important note. The information we've gone through today is for general guidance and to help you understand the basics. Your financial situation is totally unique to you, so before you make any big decisions, it is essential that you consult with a qualified professional like the team at Pro Tax Accountant to get advice that's right for you. Thanks so much for joining me.